All right, let's dive right into this explainer. Today, we're doing something I absolutely love, putting ANI Pharmaceuticals through the ultimate investment stress test. We're going to completely strip away the daily market noise and run this company through the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, plus some modern valuation models. By the end of this, we'll know exactly what kind of stock this really is. To see if ANI can actually survive this gauntlet, we'll hit 6 key areas. We'll start with a quick snapshot, run through our 3 guru lenses, crunch the numbers on a DCF model, and then wrap it all up with a final synthesized verdict. Let's get to it. Section 1, the snapshot. Let's see exactly what ANI Pharmaceuticals brings to the table. So, anchoring our analysis today is the current share price of $81.68. That gives the company a market cap of roughly $1.86 billion. Now, that puts them squarely in the small to mid-cap space, which, as you know, is traditionally a really fertile hunting ground for both value and growth investors. Okay, but what do they actually do? Basically, ANIP develops and markets prescription pharmaceuticals. But here is the real story. They are pivoting hard toward higher-margin specialty revenues. While they do have generics and established brands, they are really betting the farm on their rare disease franchise. And the absolute star of the show here? That would be their purified cortrophin gel. And wow, the stakes become crystal clear when you look at this trajectory. Cortrophin gel revenues just rocketed up 42.1% year over year in the first quarter alone, jumping from about $52 million to over $75 million. This single drug is the main engine driving their raised 2026 guidance to over $1 billion in revenue. It's huge. All right, moving on to Section 2, the Warren Buffett lens. Here we are looking for quality, an economic moat, and that all-important margin of safety. You know Buffett, he absolutely demands an economic moat. So is ANI building one? Well, they're certainly trying to dig a narrow moat with that rare disease portfolio, targeting highly specific, underpenetrated conditions like acute gouty arthritis flares. By using a dedicated 90-person sales force, they're carving out this specialized niche that's honestly a lot harder for generic competitors to just swoop in and disrupt. So how does ANIP actually measure up against the classic Buffett checklist? Well, it boasts a solid 18.3% trailing return on equity, easily clearing his 15% hurdle. Plus, management is showing some real shareholder alignment with a brand new $100 million buyback program. But, and it's a noticeable but, the company swung from historical losses just a couple of years ago to profitability today. So earnings consistency is, well, a little spotty. Add in a debt-to-equity ratio of 1.45 with $625 million in outstanding debt, and you have to wonder, would the Oracle of Omaha be a bit too cautious to bite? But here's the thing. Where Buffett might frown at the debt, he's going to smile at the cash. When we look at owner earnings, and we're using free cash flow as a proxy here, the picture gets a lot brighter. With $58.4 million in Q1 operating cash flow and a trailing free cash flow per share around $8.46, those approximate owner earnings are incredibly robust relative to the share price. Since it's trading at less than 10 times that free cash flow proxy, that just might give Buffett the exact margin of safety he's looking for. Next up is Section 3, the Peter Lynch lens. We're talking growth, categories, and the PEG ratio. As you probably know, Lynch famously divides companies into 6 categories: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. So we've got to ask, where exactly does a company with 20.5% quarter-over-quarter revenue growth and an absolutely massive 88.1% EPS growth actually fit? Yep, you guessed it. ANI plans squarely in Lynch's absolute favorite category, the fast grower. These are those small, aggressive, scrappy enterprises growing at 20 to 25% a year. And that cortrophin gel, it's acting like rocket fuel, propelling ANIP straight into this high-octane tier. Now, the valuation math Lynch applies to these fast growers is just fascinating. You take the PE ratio, which sits at 20.9, and you divide it by that massive earnings growth rate of 88.1%. What do you get? A PEG ratio of just 0.2. To put that in perspective, for Peter Lynch, anything under 1.0 is considered good, and anything under 0.5 is fantastic. So a 0.2 PEG, that is a screaming, literal buy signal for Lynch. All right, let's switch gears. Section 4, the Benjamin Graham lens. Time for deep value and ruthless intrinsic math.
If we run ANIP through Graham's famously strict defensive investor checklist, it's kind of a mixed bag. The $1.86 billion market cap gives it adequate size, so that's a pass. Its 3.1 current ratio is incredibly strong, showing massive short-term liquidity. Another pass. But Graham demands 10 years of totally stable earnings and a long history of uninterrupted dividends. Since ANIP has historical losses on the books, that's a fail. And it pays exactly 0 dividends. Another fail. So a strict defensive value investor might just walk away right here. But hey, let's actually show our work on Graham's famous intrinsic value formula to see what the stock is fundamentally worth. We plug in the forward implied EPS of $8.37, which we backed into using their 9.75 forward PE, and multiply that by the $20.29 book value per share. Multiply that whole thing by Graham's 22.5 constant and take the square roots. The result? We get a strict Graham fair value of $61.81.
So, at $81.68 today, ANIP simply does not offer Benjamin Graham his required margin of safety. The cold, hard math tells us that this stock is currently being priced for its future growth trajectory, rather than its present tangible book value reality. Moving right along to Section 5, DCF and Alternative Valuation Models. Let's project some future cash flows. By forecasting free cash flows based on their freshly raised 2026 guidance, we built a detailed DCF sensitivity table. Assuming a standard 10% weighted average cost of capital to discount those future cash flows and a really conservative 2% terminal growth rate, our base case DCF yields a fair value right around the Wall Street analyst's median target of $110 per share. And get this, even if we bump our discount rate up to a stricter 12%, the value still sits at $95. That is well above the current trading price. As a quick alternative valuation check to our DCF, let's look at comparable multiples. Zacks Investment Research notes that ANIP trades at an absurdly low 9.75 times forward earnings. Compare that to the broader sector average of 20.3 times. Honestly, ANIP looks dramatically undervalued relative to its peers. That is, of course, assuming it can actually hit those forward earnings targets. Finally, Section 6, Synthesis and Final Verdict. Let's bring all these lenses together. Here's our ultimate synthesis table, and it is fascinating how different these perspectives really are. Peter Lynch and the modern DCF models see massive upside, heavily weighting that incredible growth. Buffett is, well, cautiously optimistic. He loves the cash flow and the buybacks, but that debt keeps him at a hold or maybe a weak buy. Meanwhile, Benjamin Graham actively avoids it because the price demands a premium over its tangible book value. Blending all these insights together, the narrative is pretty clear. The strengths are undeniable. Cortrophin Gel is an absolute powerhouse. The $100 million buyback provides a nice floor, and those forward multiples are undeniably low. The risks? Well, you've got to stomach the intense competition of the pharmaceutical space and some heavy customer concentration. But if you believe management can navigate that competition and sustain this rare disease growth, ANIP is a clear buy at current levels for growth investors. But for the deep value purist out there, it's a definitive pass. So as we wrap up this explainer, I have to ask you, looking at all this data, where do your own investment instincts lie? Are you a growth-hunting Lynch, a quality-seeking Buffett, or a bargain bin Graham? Keep that question in the back of your mind next time you evaluate a stock. Until next time, keep learning and keep analyzing.